With the stock market hitting record highs recently, it's been hard to find a good stock to invest in. But today, I came across a pretty decent stock called Tapestry, ticker symbol TPR. If you don't know, Tapestry is a holding company. They own 3 major brands. One of them is Coach. Coach is a high-end brand. They make clothes, backpacks, wallets, shoes, belts for both men and women. They also own a brand called Kate Spade. It is a very similar brand, except that they only sell women products. And the third brand that they own is called Stuart Weizmann. You probably haven't heard of it because my YouTube analytics tell me that over 90% of my viewers are male. Stuart Weizmann sells shoes for females, and you can think of them as a Foot Locker for girls. They sell many types of shoes like heels, boots, and sneakers. It's essentially the woman's version of Foot Locker. And this company has been a very fast growing company. During 2015, they made about $402 million in net income. And over the past few years, Tapestry has been able to grow that amount to about $643 million in net income by 2019. That's about 60% growth over the past 4 years, or 15% growth per year in their earnings per share. But their growth is definitely not going to be maintained at that rate in the near future due to the illness. As of August 12th, analysts expected Tapestry to lose 56 cents in EPS during Q2 of this year, which compares to the 61 cents that they made last year during Q2. Although this seems pretty bad, they actually just came out right now with their Q2 earnings and they reported better than expected earnings, with only a loss of 25 cents per share for Q2. Although this is still a loss, you have to remember that the lockdown started at about the beginning of Q2, and their stores were closed during the lockdown because no one really needs high-end sneakers during a lockdown. So they were not generating any revenue for a good portion of the lockdown, but they still had to pay a lot of expenses associated with owning a business. So it would be very unrealistic to expect that they would make a profit during Q2. And given that they came close to breaking even, only losing 25 cents in EPS, I think that's actually pretty good. But now, their stores are open, and this is going to start translating into earnings. For next year, they are expected to make about $1.59 in EPS. And that puts them at a forward PE ratio of 10. And that's very, very low. And for a company which has potential to grow pretty fast when the economy gets stronger, that's a fairly good PE ratio. I mean, just take a look at their store numbers, especially with their international stores. In 2015, their Stuart Weizmann brand had only 8 international stores. And now they have over 70 locations. Their Kate Spade brand had 142 stores in 2018. And by 2019, they had over 190 locations. So the brand definitely has a lot of upside potential for their valuation once the economy gets stronger, which can make it a decent long-term play. But there's a problem. The company's balance sheet is not the greatest at all. As of right now, they have $1.5 billion in long-term debt. And as of right now, they are on track to make about $300 million-ish in free cash flow or profit essentially next year, assuming that the economy does not dramatically improve. So Tapestry has to be able to pay back $1.5 billion while only making $300 million per year. And once again, assuming that the economy does not dramatically get better or worse. And that's not an easy thing to do. It's not going to be easy for them to pay back all that money because they owe so much money. However, if their sales are able to return to their pre-pandemic levels, then I don't think that their debt would be a problem because they would be making much more money than $300 million per year to tackle their debt. Before the pandemic, they were making $600 million per year. And having $500 million or $600 million per year to tackle $1.5 billion, that's much more reasonable and realistic for the company. So their debt would not be a huge problem if they're able to reach their pre-pandemic levels. But as of right now, I don't think that's going to happen in the near future unless something dramatic happens soon, like a vaccine being administered to everyone right now. But there's another hidden issue with the company's balance sheet. Since they've been expanding so much and opening stores all across the world, they've needed to get some leases. On their balance sheet, it's written as capital lease obligation, and it's oftentimes listed on a separate line from a company's debt, and many investors don't actually pay attention to it because they sometimes forget about it. But it's so important for an investor to pay attention to a company's capital lease obligations, because your companies might owe billions of dollars and you might not even know that they have that obligation, and it might make a balance sheet seem very dangerous when you thought it was actually squeaky clean. As of right now, Tapestry is currently obligated to pay an additional $2 billion in lease payments, which is definitely a lot of money. But this is not the worst thing in the world for two reasons. One, these leases are not interest-based. They don't have to pay interest on their leases. So it means that the amount they owe is not going to grow over time, which is just a little bit helpful for the company. But number two, most lease agreements have very long terms. So over time, the company will be able to grow their earnings. And as they grow their earnings, it's going to become easier and easier and easier to pay back their lease. In fact, over $1 billion of the company's lease payments are not due until after 2025. So there's not going to be any short-term issues with the company's balance sheet. The management team is also making some pretty good decisions right now, which I do like. For example, they hope to keep margins strong by keeping inventory levels lighter. As one example, the Coach brand will have 50% less handbags for consumers. When they have less inventory, they're going to be able to sell a larger portion of their inventory. This means that less inventory is going to have to go unsold. This means that less inventory is going to have to go on sale so that they can get rid of it. They are focusing on selling their best products, which I think is a very smart move by the business. Also, by reducing their inventory levels, they're focusing on selling their best products, which is always a smart move in a business. Also, they're aiming to cut down on costs, which is a very smart decision right now. Tapestry said it will become leaner and estimates it will reduce expenses by $300 million, including $200 million projected in fiscal 2021. Also, Tapestry's management decided to suspend their dividend and stop their share buyback program. Last year, they spent about $500 million on paying dividends and buying back stock. So they're definitely going to save a lot of money by suspending those two things. And I think that's definitely a very smart move by the management. This can allow them to have extra cash on the side just in case something goes wrong or if the recovery is slower than expected. But for me personally, I'm not buying the stock right now. I do think it needs to come down a little lower by at least a couple dollars to make it a very good investment in this company. And I also recently invested in Foot Locker, which is a very similar company in terms that it's a retail stock and that's also being hit pretty hard by the coronavirus. So I don't want to invest in another stock that's very similar to Tapestry. But let me know what you guys think of this stock down in the comments below. I would love to hear your thoughts, and feel free to ask me any questions that you have about the stock market. I would be happy to answer them.